we're talking about covered calls today. We've been getting a lot of questions about adjusting covered calls, adjusting covered strangles, covered straddles, and how you can manipulate the strikes and really the decision-making process behind it. So figured why not just do a quick review here, and then we can come back to my Microsoft position and we can literally show you exactly what this is in real time. But I took some screenshots that I think will be helpful, and this is really the most simple way you can think about it. I think a lot of people make this more complicated than it needs to be. So hopefully this segment is helpful when it comes to rolling positions out in time, rolling positions up or down. It really comes down to one simple transaction and if you focus on that simple transaction, it makes your life a whole lot easier. And this could really be applied, what we're talking about today, can be applied to short puts, can be applied to covered calls, can be applied to strangles, straddles. Anytime where you have a short premium component that you're buying back and you're moving it out in time, it applies to that strategy if it's undefined risk. So
yep. Diagonal spreads, iron condors, anything that's short premium that you're rolling, this can apply to.
Mm-hmm. All right. So covered calls. Covered calls can profit in two ways, really, or a combination of two ways. One is from the extrinsic value decay of the short call, and that could be from a passage of time decaying that option. It could be from implied volatility contracting, which brings that extrinsic value down. It could also be from a bullish movement in the stock price, specifically for a covered call, in which case, yes, your short call in isolation might be showing an extrinsic value loss, but your shares are going to offset that because your 100 shares that you own, that 100 delta is always going to be a greater delta than your short call. Your short call's short delta, unless of course your short call's in the money at 100 delta, 100 short deltas, and then your 100 long shares are completely offset. But for the most part, your short call is always going to have a lower short delta than your 100 shares will have. So you could have one of those two things. You could have a combination of both, but ultimately at the end of the day, the more premium you collect in the short call or overall from covered calls or covered strangles, covered straddles, from whatever position you have, the more premium you have to collect, the less you need the stock price to move up to be profitable. Because if you have a $400 credit, like we're showing here, you can actually be profitable. Even if the stock goes down 3 points, you're still at a surplus of $100 there. You collect $4, the stock goes down 3, you would still make $100 in this scenario if this option were to expire worthless. So, of course, if you have $8 or $10 or $12 in premium, you can allow the stock to actually go against you by more of a degree and still be profitable. So that's why we like to collect a decent amount of premium. We like trading or selling premium in high implied volatility products because all of those things exist. The more premium you collect, the more the stock can move against you and you can still be profitable.
Yeah. It's also why we're not selling the far out of the money junky options, because you're not getting paid to take the risk. And by risk here, I mean capping the upside, right? So if you're selling, 5 delta calls, sure, it's 95% probability of being out of the money, but you're capping where your profit potential is with very little decay component, very little basis reduction against your position. You got to kind of weigh the pros and cons of wherever your strike is. And selling a $4 option, it gives you a lot of that buffer to the downside and enough extrinsic value to make it worthwhile. But if you do get the move, you can still make adjustments to that position moving forward. And I know that's what you're going to be getting into here.
Mm-hmm. Yep. And of course, if you're picking up more premium and, you're at the expected move, within the expected move, just outside of it, whatever the case is, it's really subjective when it comes to that point. But really, however much premium you have, or the more premium you have, the more downside protection you have as well in the case of a covered call. So what happens when you have a covered call and you're looking at rolling that short call out in time? So this image is just showing you the raw value of the position. If I were to roll the short call that I have in December or buy it back and sell out a new short call in January, if I buy this back at the 410 strike and I sell out the 410 strike in the next month, you can see there's a difference in extrinsic value premium here. I'd be buying back the option for $4. I'd be selling out of the new option for $8.55. So if we just round this to $4 and round this to $8.50, this is a net credit of $4.50. So this is why we don't focus on, rolling is booking a loss and you're just locking in a loss. You're really not. If you sold that 410 call in December for $1 and now it's trading for $4, then yes, the transaction would be a loss of $300, but the trade is not over. That's the whole point, is that you're buying back this option in December, you're moving your position out to January, and you're picking up a net value that's greater than whatever loss that you've created in the transaction. So in this case, if you collected $1 to initially sell this 410 call, and now you're picking up another $4.50 of a net credit, your new net credit is $5.50. So if your new option expires worthless, you've gone from a $100 value gain, which is what your initial short call was, to a potential $550 net gain. So it completely wipes away whatever transaction you booked when you made that roll. So that's why we don't focus on that. We focus on what is my extrinsic value collected here and how does that change the position. But at the end of the day, when you're rolling a short call out or a short put out or a strangle or a straddle, any option position that is undefined risk, you're going to pick up extrinsic value, and it does not matter whether it's in the money option, at the money option, or out of the money option, assuming there is extrinsic value in that strike and assuming that you are dealing with a liquid marketplace. This is because there's always more extrinsic value premium out in time on the same strike because there's more time for the stock to move. And that translates to uncertainty of where the stock will land at expiration. And this is really the risk premium you are getting paid to take the risk. And in the case of a covered call, you're not necessarily taking upside risk here, but you are capping your upside profit potential. So you're getting paid to do that. If this were a short put, you would be taking risk and you would be getting paid to take that risk. And the more time you have with a short put or any strategy like that, you're getting paid more because you're taking time risk in that form as well as implied volatility value. So we get the question all the time, like, what's a strategy where I can make profit month over month? I think a better way to look at that is analyzing it by revenue collected, which is your extrinsic value, because profit depends on where the stock is, but revenue from extrinsic value is something that you can always calculate and something that you can always put your hat on because you know what's going to decay. In this case, in January, I know that this 855 extrinsic value is going to zero, regardless of whether SPY's at 425, 385, 395, or whatever. Mm-hmm. So when you're rolling out in time, you're going to be picking up a credit if you use the same strike because of this risk premium.
The big idea. I like this.
The big idea, and this, again, applies to any short premium strategy, but specifically and most importantly, undefined risk strategies that you're rolling out in time or trying to manipulate. Regardless of where you're moving your strike out in time, whether it's to January or February or whatever, or what strike you're adjusting to, you're executing a simple transaction, ideally for a credit or a scratch, and we'll get into that in a little bit. But this is what we focus on, this transaction. You're buying back your current position for X value, and you're selling out a new position for a bit more than X. So when we talk about rolling for credits, as long as you are buying back your option that you're closing, and you're selling out a new option for a little bit more than what you paid to close that option, that is rolling for a credit. And that's really what we're doing when we're moving positions out in time, rolling out in time to the next month, maybe adjusting the strike a little bit. The idea is to do it for a scratch or pick up a credit for the most part, because that is what reduces our basis time and time again over time. And that's really what we want to do because we can't predict where the market is going to go 100% of the time. Sometimes you'll be right, sometimes you'll be wrong. But if you're continuously reducing your cost basis, that is the main focal point of what we're doing, because it allows us to be wrong and still be profitable. And it allows us to bring that cost basis down, especially in covered calls, to a level where now at a certain point, if the stock stays the same or goes up or goes down, the more premium we collect, the less directionally right we need to be, which is how you can be sustainably profitable over time. So here's where we get into a little bit deeper in this analysis. So instead of just rolling the short call out in time, like we just looked at, what about rolling the short call out in time and up a little bit? So when you're rolling the short call out in time, in this case, going from December to January, and you're moving it up, you're going to be picking up extrinsic value by moving that strike out in time, or you can give up that extrinsic value to move your strike further up on the strike plane, which is really just a trade-off in terms of how much more your shares can be profitable if the stock continues to climb, compared to rolling to the same strike and keeping that same cap of where your shares can go. And you're making that decision. You're doing one or the other. Ultimately.
This flips from extrinsic value to intrinsic value, though, in terms of your upside on this position, right? So if you're rolling the same strike and you're collecting, what was the example? It was a $4 credit
50.
Or something.
Yeah,
$4 or $5 credit from rolling it out. That's extrinsic value, or $4. Yeah. So if you're $4.50, you're getting that $4 in extrinsic value. That's value that you're going to capture. So if the stock stays right where it is or goes lower, that's value that you're banking, through that roll via extrinsic value. If you're rolling it from the 410 to the 422 and you're doing this for flat, the value, if the stock stays right where it is or goes down, of this transaction isn't going to change. You don't capture any added extrinsic value. So if the stock goes down $2, you'll be out $2. Whereas if you rolled to the same strike and collected $4 and the stock goes down $2, you make $2. So there is a caveat to this, in that you now need the stock to make that movement higher. And for a lot of people, this adjustment makes more sense if you're trying to hold the stock. You want to keep this for a longer period of time. You're still bullish the stock, but you still want to keep that extrinsic value that you originally sold. This is the sort of adjustment you can do where it gives you that extra buffer to the upside, but you still is a net positive extrinsic value position because you still have that extrinsic value that's on the table from the original transaction. Right.
So when we go back to that example of you initially sold that call for $1 and now it's trading for close to $4, it still doesn't matter to us because the trade is not over. And that's the whole point. The trade is not over. So if I were to have made this move, buying this back for $370, rolling it out to January and up to $422 for $372, this is technically a net credit of 2 cents. So what does this do? It means that I now have a $422 short call against my 100 shares instead of a $410, and my net credit overall is $1.02. That's it. So I don't care that I booked a $270 loss on this call because, again, the trade is not done. It's not over. If the trade was over, then that's totally different. And that's a different conversation. But if you're rolling and you're keeping the trade active, I don't care about the transactional loss that I booked because the trade is not done yet. So ultimately, what you're doing here is instead of keeping the same keeping the same strike and picking up more extrinsic value, what you're doing here, like Nick said, is a purely offensive roll where you are buying back the short call in December and you are selling a new short call in January, and you're moving it up as much as you can for a scratch or small credit. In this case, you could go to 415, 420, 422. But here, I just wanted to show that you can move it up as how much you can move it up for a scratch if the strike is out of the money. So doing this is an offensive roll because you're not picking up extrinsic value to reduce your cost basis to the downside. You're really just moving your strike up as much as you can to keep your shares, give yourself a higher probability of keeping the shares, not being called away. And also your intrinsic value profitability is now at 422 or up to 422 instead of being up to 410. So this is an offensive roll for all of those reasons.
You also still have the extrinsic value on the table that you originally had in the 14 day, right? So if you sold it for $1 and now it's trading at $4, that's $3 of value that you missed out on via the increase in extrinsic value. You're rolling this forward so that if this new option that's 49 days to go till expiration, if that expires out of the money, $4 in value is going to be realized for you out of that position. You're rolling that, forward and up, but keeping that on the table. That the $4 debit or the $3.70 debit that you are buying the option back for, it's in that transaction is, a realized value, but you're opening that same value further out in time.
Right. And that's why if you were to do this for exactly 370, and the stock were to be exactly where it was, you would just have $100 profit. Regardless of how you got there, you would have, of course, booked a loss in this transaction, but this transaction would have wiped away this loss and you would have been left with your $100 credit. So again, that's why we don't focus on the transactional loss when you're rolling, because the trade is not done.
Yeah.
So if I could put stars all over this slide, I would, but it wouldn't be nice to look at, and it would make things unclear. The reason why I say that is because what we're about to talk to is when we get the emails. We get the emails, like, how do I defend this short call? What do I do with the short call when the short call is already 10 points in the money? And that is where you run into issues when it comes to the flexibility that you can have when you're moving these strikes out in time, and the ability to move it up in the case of a short call, or the ability to move it down in the case of a short put, or a combination if you're talking about strangles or straddles. So
without doing it for a debit.
Yeah.
If you're 10 points in the money, you're going to be paying a debit, but you can still gain intrinsic value.
So if you're trying to make the most out of this situation, rolling before the strike goes in the money is literally the most important thing. I could not stress that enough. And we're about to see why. So here, you can do this for a scratch, rolling from December to January, and you can move it up 12 points because you're just dealing with extrinsic value. Both of these short calls are out of the money. You're only dealing with extrinsic value here, which gives you the greater flexibility of where you can move this strike and still do it for a scratch. In this slide, we are changing the assumption to that instead of selling the 410 call initially, we sold the 395. And now with SPY, wherever it is, I don't know where it is right now, but
it's at, I'll give you right now, 405.
Okay. So right where this image is, but this is the issue that we're talking about. The issue is that now that you're dealing with intrinsic value in the short call in December, it becomes much harder to replace that with extrinsic value rolling out in time. And here you can
almost impossible.
Yeah.
With an option that's dollars in the money. The further in the money you go, the harder it's going to be.
Yeah, and relatively near term.
Yes.
So if you're trying to move this up, buying this back in December, selling it out to January, and you're still trying to do it for a small credit or a scratch, now you can only move it up 7 points. And the reason is because you're trying to replace all this intrinsic value in the 395 call that's in the money with extrinsic value in the new cycle further out in time. And it becomes very hard to do. You have much less flexibility if that short call is in the money. Sometimes you can't help it. Sometimes you have a big gap up or gap down before the market opens, but oftentimes you can help it and you can make that decision and do the adjustment before the call goes in the money. You'll always have greater flexibility if you're adjusting these options before they go in the money.
Yeah. But ideally you do get some passage of time here. Like you're in the 14 or 20 day window. If it happens quickly, then you got to kind of hold a little bit of risk and keep the position on.
So how the math works out in the previous example, dealing with exclusively extrinsic value, the strike could be moved up by 12 points for scratch. and out in time, replacing extrinsic value with extrinsic value. And that's always going to mean more mobility compared to when you add intrinsic value into the mix. So in this example, you can only move the strike up 7 points for a small credit. And again, it's because the short call that you're buying back has too much intrinsic value to replace with extrinsic value in a further dated cycle. But like Nick said, you're still giving your shares more room to be profitable, because in the previous example with 395, you're capped out at 395. But if you're going from December to January and you're moving it up from 395 to 402, what are you doing? Even if you're doing it for a small scratch or a small credit scratch or even a small debit, you're moving the call that caps your upside profit potential in the shares up 7 points. And this is why this is really a synthetic credit roll of 739, because I'm picking up 39 cents of actual premium, and I'm bringing this call further up the strike plane by 7 points. So I'm really picking up 739 in this case. But I think the easier way to look at it, instead of like doing this and getting to this number, I think an easier way to look at it is just looking at your credit received, 39 cents, and then just realizing that, okay, now my shares can actually profit by another $700 if the 402 call remains in the money, because I'm moving it up 7 points, I'm picking up 39 cents to do so, and that's how you get to this number. So at the end of the day, covered call flexibility is pretty endless, like we're showing here, if you're clear of this concept of rolling out in time or rolling out in time and up on the strike plane. Think of it as a simple transaction, and this can be applied to any undefined or short premium trade. When you're replacing the debit of X with a credit of a little more than X in a further out expiration, that is a net credit. That means that your new position that you're rolling into can offset any sort of loss that you are seeing in that position. And that is the easier way to think about it relative to trying to keep track of the transactional losses you're booking and then looking at the raw value. Just keep track of the net credit received, and that's how you can easily keep track of your overall P&L. And that's what the order change does on the Tasty platform. For max profit calculations, any debit or credit in the transaction is then totaled and applied to the new strike, not the old one. So in the examples that we were looking at before, we're not looking at our previous strike. We're looking at the net credit received from these positions, and we're continuously applying them to the new strikes that we're either rolling out in time or rolling up, et cetera, et cetera. But for the break even to the downside, that's always going to be calculated off of the purchase price of the shares. And if you keep piling up small credits or large credits or medium-sized credits, and you're moving the strike up and out or keeping the strike the same, we're giving ourselves more offensive potential from a profitability standpoint, but we're still reducing the cost basis at the same time. So think about it as like buying a house. When you buy a house, if you are paying down your mortgage and building equity, you are reducing your cost basis on that home. And if you assume that that home's going to appreciate over time, it's a very similar idea as what we're talking about here, where you're reducing your basis to the downside as long as you're collecting credits in these positions, and you're giving yourself more offensive profitability to the upside if you're moving your strike out and up, or even if you're just moving your strike out in time, because you can utilize that credit as profitability. If you have a covered strangle or a covered straddle instead of just a covered call where you just have the short call, all that means at the end of the day is that you have more flexibility because you're collecting more when you're rolling out in time. So in the previous examples where we were looking at doing it for a scratch with just that short call, or doing it for a $4.50 credit, if for the rolling the call out in time, if I now add a short put, I'm going to be collecting way more premium. So that means that I can either move my short call way further out in time, or I can move both my strikes further out in time, or not out in time, out on the strike plane. And because I'm picking up more credit, like we've talked about before, the credit that you have gives you flexibility. So the more credit you're picking up from rolling month to month, the more flexibility you have to make decisions based on what you want to do and where you want to have your new upside cap and a covered call, or where you want to acquire shares at a lower basis with your short put. So if you have a covered straddle or covered strangle, same things apply, but you're picking up twice as much credit, most likely, which allows you to have greater flexibility than even just a short call. But of course, having a short put component does add more risk.